In this video, we're going to talk about T accounts. So T accounts is a great way to learn accounting. I'm going to be using T accounts a lot throughout my videos, so I kind of want to introduce it to you guys right now. So I'm going to set up a T account for each one of the 5 main accounts. We have assets, liabilities, shareholders' equity, revenues, and expenses. In any given T account, the left side is always going to be debit, the right side is always going to be credit. Debit, credit, debit, credit, debit, credit, debit, credit. So when we say asset is a debit account, that means on the debit side it increases. By default, on the credit side it decreases. Now, liabilities is set to be a credit account. On the credit side it increases. On the debit side it decreases. Shareholders' equity is set to be a credit account. On the credit side it increases. On the debit side it decreases. And now revenues. So people always think revenues is a debit account. However, let me explain to you why now revenue is not a debit account. In fact, it's a credit account. So remember, shareholders' equity, we can kind of think about shareholders' equity as a company's net worth, or in other words, their assets minus their liabilities. It's the ownership stake in the business. So if you think about this from a logical standpoint, the higher our company's revenue, the higher their net worth, or essentially the shareholders' equity. So by default, if equity increases on the credit side, revenue also increases on the credit side because revenue increases your shareholders' equity. Then by default, expenses decreases our shareholders' equity, which is why expense is a debit account and increases on the debit side. Or in other words, if revenue is credit, remember, revenues and expenses are opposites, correct? So if revenue is a credit account, by default, expense has to be a debit account.